So Jim Rickards argues that the price of gold is manipulated. Today we examine his view on price manipulation and how it occurs, and whether the suppressing of gold prices can actually be sustained. After all, if you're buying into gold, you want to understand all of the factors that can actually influence its price. So let's dive on in. Now, this channel provides global macro insights for informed investing, so do consider subscribing. So Jim Rickards argues that there is hard statistical, anecdotal and forensic evidence that the gold price is artificially suppressed. His conclusion has been hardened by the work of PhD mathematicians, as well as conversations with members of Congress, the intelligence community, experts in price manipulation and senior staff at the IMF. Why would they wish to suppress the price of gold and silver? Well, remember that gold reflects concerns of economic fragility or falling confidence in the currency. Therefore, it makes perfect sense as to why gold and silver prices, in the eyes of authorities, should be suppressed to help maintain confidence in fiat currencies. Now, Jim Rickards actually quotes one unnamed expert saying that he said it was the most blatant case of manipulation he'd ever seen. He said if you went into the aftermarket, bought after the close and sold before the opening every day, you would make risk-free profits. He said statistically that's impossible unless there's manipulation occurring. So how do these manipulations occur? Well, Jim states that it comes down to the way in which the gold market operates, with the price of gold being set in two locations. One is the London spot market, which is controlled by a handful of bullion banks such as JP Morgan, HSBC and Barclays. The other market is of course the COMEX futures market in New York, which is governed by its big clearing members, which include many major Western banks. According to Jim, big Western banks have an effective monopoly over the gold market. Both markets here trade paper gold. So how is this manipulation conducted? Well, according to Jim, a massive sell order can be put in just before close. This scares those that are long into lowering their bid. Lowering the price dynamic like this acts to discourage investors into bullion and hurts market sentiment. But it also spooks hedge funds into dumping gold and reinforces a self-fulfilling momentum before the market eventually bottoms out and buyers then step back in. Given the substantial leverage that's actually used in the futures market, around 20 to 1, it means that $10 million of cash margin can sell $200 million of paper gold. Moreover, hedge funds will trade gold not as a long-term position, but as any other commodity, using stop losses. This is irrespective of their long-term view on the metal. But when a large sell order comes through, these stop losses prompt those hedge funds that have taken long positions to sell, and the downward momentum perpetuates. But let's delve a little deeper into this market and explore whether this price manipulation can actually persist. Now, first, let's concentrate on the Bank for International Settlements, the BIS. Now, BIS members are large central banks, and we can see some examples of them here. They have significant gold sat in the vault. Some of this gold may be secured for other countries, and some may be that country's own storage of gold. But as this gold is generating no yield, they may choose to actually lease out a proportion of their overall gold to bullion banks. Gold lease rates are generally very low, as we can see here. So the bullion banks take this gold from the central bank, promising to return it at a set point in the future. They then sell this gold as unallocated through paper contracts and buy high-yielding government debt, allowing them to make healthy spreads against the gold lease costs from the central bank. Nice, easy profits. But unallocated gold contracts allow the gold to be sold many times over by the bullion bank. This makes them vulnerable to the equivalent of a bank run if everyone requested delivery at the same time. Now, Real Vision co-founder Grant Williams has compared this to a pyramid scheme in a presentation on the leasing mechanism of BIS members. So a large gold buyer may go to JP Morgan, HSBC, Citibank or another and put in an order for $5 million of gold, and they will be given a written contract for physical unallocated gold. They will not be given the serial numbers of the gold bars that their money has actually purchased or supposedly purchased. This is deliberate to provide bullion banks with the flexibility to find and buy gold should clients actually request delivery. And just as a reminder, we can see in Gold Money's gold risk pyramid that while less risky than ETFs, provision of unallocated gold comes with clear risks, while future contract risks are at the top of this inverse pyramid. In normal times, few people want to hold gold due to storage and transportation problems, but when confidence fails, people want to hold their gold. What's particularly concerning here is that, as this Seeking Alpha article comments, that as the gold price rises, bullion banks will actually issue more and more paper contracts, thus inflating the supply of paper gold obligations. But this means that the whole risk of the system grows. Now, William R. White, the former head of the BIS Monetary and Economic Department, stated in 2005 that central banks collaborate to influence asset prices, especially gold and foreign exchange, in circumstances where this might be thought useful. Recently, we've seen real signs of stress within the gold market, witnessing the LBMA COMEX spread. That is the difference between these two paper gold markets and the prices that are quoted between them. Ronan Manley, writing for the Bullion Star, has said, in essence, the contango phenomenon we are seeing is one of gold future prices trading far above spot gold prices, a sign of liquidity problems in the London gold market and a signal that something is completely broken between the world's two predominant gold price discovery trading venues. But where this Ponzi scheme gets really interesting is that, as well as collapsing from the bottom of the pyramid by people requesting delivery of their gold, this house of cards could actually collapse in on itself from the top. Imagine countries all at once approaching the Bank of England and asking for their gold to be repatriated. Initially, such claims could be met, but in an all-out panic, will the Bank of England actually have sufficient metal available? Well, we know a good proportion will be leased to the bullion banks, and while all of these central banks record significant gold holdings, their balance sheets actually record quite vague terminology. Here's the gold holdings that Grant Williams has pointed out, and compare them with the vague terms that are used on their balance sheets. A bank run on the central bank would then mean that the central bank needs its gold back from the bullion banks. The bullion banks would then have a real problem with no physical gold behind their paper contracts. So as Jim Rickards has said, that in the short run you can't beat them, but in the long run price manipulations have a finite life, and that price suppression like this always fails. Here's our summary, and if you found this video useful, do smash that like button, share and consider subscribing. Now, if you want to know why gold ETFs are not necessarily a great long-term investment, do check out this video. Otherwise, I'll see you next time. Bye bye.